So while we're just waiting for a few more people to come on the call, I'll just welcome everyone that's here already and let you know that we do have the chat open. So you can feel free to use the chat throughout the webinar to make comments, or if you're looking for particular information, you can find it and use the chat. You can also send private messages to each other through that chat. The Q&A is also open for this webinar, and this is going to be where you can go ahead and type any questions you might have for our panelists into the Q&A. They will be answered throughout the webinar. If you have something that's pertinent to what's being talked about, then you can, we'll try and get to it at that moment. If not, any other questions will be answered at the end. So I think it is after 12 o'clock now, so we are going to get things started. My name is Suzanne Andrews. I'm the CEO at the Quinte West Chamber of Commerce, and joining me co-hosting this event is Jill Raycroft, who is the CEO of the Belleville Chamber. So thanks, Jill, for partnering with us on this. I know this is a really important topic. Many businesses still aren't aware of some of the changes that are happening in the insurance market. And joining us today is Matthew Doty and Mark Ellis from Whitley Insurance and Financial Services to give you an overview of what's happening in the market. Hi guys, thanks for joining us today.
Hi, Suzanne.
Yeah, so we're going to let them sort of lead you through a presentation about what's happening in the market, why things are a little bit different, and I think more importantly, what you can expect when you go to renew your policy over the next few months, what you might be encountering that you haven't encountered in the past. Is there anything else you guys want to add to that before you go into the formal presentation part of the webinar today?
No, just I want to welcome everyone to coming to the event today. It's nice to take your lunch hours to join us to go over this topic. As Suzanne said, please feel free to jump on the Q&A section at any time. If you have any questions, we'd like to make this as interactive as possible.
Okay. All right, so I think we'll go ahead and get started. We are recording this, so you guys will be able to watch it again later if there's some things that come up that you missed or you needed to hear it again. There will be a recording available shortly after the webinar today, so you feel free to take notes, but it will be available. And I think, Matt, you said you were going to share your presentation as well, the link to it that I can share out with people if they need it.
Yeah, I can try to send you the PowerPoint or a printout of it. It's a pretty large file, but yeah, we can set something up for you.
Okay, very good. All right, so we're gonna let you take away on the presentation.
All right, thank you. All right, everyone. So welcome to everyone again. Myself and Mark welcome you to the webinar. Just a little title page here for you. As an introduction, my name is Matthew Doty. I'm an account executive here at Whitley Insurance. I've been in the insurance industry for about 6 years. Started in the personal lines, and for the last 3 years I've been concentrating wholly on commercial, the industry. Prior to that, I actually lived overseas for about 10 years in Asia teaching. I'm a member of the Quinte West Chamber, and I guess now this could be changed now. I'm no longer the current president of the Kiwanis Club. I'm the past president as of a couple of weeks ago. And Mark?
Good morning, everyone. Thank you for joining us today. My name is Mark Ellis. I've been in the insurance industry for close to 3 decades now, both in the UK and Canada. Started off originally as a senior claims advisor for a syndicate at Lloyd's of London before moving into broking in the late 90s. I've been dealing exclusively with commercial clients since that time, and for the last 5 years and a bit here in Canada, in both Trenton and Belleville, and certainly enjoying the change. Over the years, had all kinds of inquiries, some interesting, some more mundane, but we've been able to help billionaires, aristocrats, royalty, presidents of entire countries, and everything in between. But Yeah, just happy to be here, and thank you very much for your time today.
So we just wanted to give you a bit of an introduction to both Whitley and Navicord. Whitley has been in the Quinte region since 1949, so 71 years. And for the past 5 years now, we've been a part of Navicord, and Navicord is a growing group of broker partners from coast to coast. We have representation in just about every province now. I think Manitoba is the only one there is no representation. And we, as a commercial brokerage, we're about the 4th largest commercial brokerage in Canada. And one of our taglines is, building the great Canadian brokerage. We're operate a little bit differently than the larger brokerages in that we have a small town feel to us, but we have the ability to reach out to markets that a lot of companies don't have access to.
The key motto there is local touch and national strength. So we are able to leverage the strength of Whitley and the Navicord Group with all of the insurance markets and partners that we have, which is a huge advantage. There's not many insurance companies that we don't deal with. We've got many different MGAs, which are managing general agents. We'll come to that in a moment. So we really do leave no stone unturned when it comes to being able to satisfy and service our accounts.
So I guess the part that everyone is here to kind of to understand better is what's kind of going on today in the insurance market, and what we are seeing in probably for the last year or so. We've been moving into what they call a hard market in our industry. This is a time where you're seeing a lot of changes that will impact your premiums, the kind of coverages that you're able to get, the markets that you're able to kind of go after. So you can see the list there. There's some of the indications of a harder market are higher premiums, restricted coverages, tougher underwriting, reduced capacity, exiting the market completely or out of a class, and renewals not being offered.
So we'll go through each of those in turn, but just to begin with, we'll go back to an Insurance 101 and just explain the basic principle of insurance. It is a contract of insurance. It's a risk transfer contract where the premiums of the many go into paying for the losses of the few. That's the idea behind it. If you think of it as a large pot of money that everyone pays the premiums into, that contract is essentially a list of promises that in a certain set of circumstances, whether it's fire or a liability issue, the insurer will indemnify, i.e. pay you under the terms of that contract. Now, insurers operate or measure their rate of success through what's called a combined operating ratio. To get technical for a minute, a COR, or combined operating ratio, means that if it's at 100%, they are paying out $1 for every dollar that they're receiving in. And as that COR has deteriorated over the last 2 to 3 years, that is the reason why we're seeing the hard market. It's not uncommon to see them well over 100%. I think at one point there was one particular insurer running at 252%. And like any business, if you're buying in at $1,000 and you're selling at $800, you're not going to be in business for very long if you continue to do that. So the common complaint, of course, or the common remark is higher premiums. I would say the average, if there is such a thing, is between 10 and 20% at the moment, but it does vary enormously on the class. There are two things that insurers essentially can do to reverse their results and to improve the combined operating ratio. One is to increase premiums, obviously. The other one is to reduce the cover that they're providing. So under the restricted coverage, quite often what we will see is something like the entire removal of sections of cover. Cyber insurance has been an extension which has been offered by many insurers, and we're now starting to see that being removed, and you now have to go back and buy that as a standalone product. Similarly, things like employment practice legal protection, that is being reviewed by insurers, or it could be something as simple as increasing a deductible for a specific event such as sewer backup, flood, earthquake, etc. These are all ways of insurers covering or improving their results. Now, the other thing is tougher underwriting. That goes hand in hand with restricted coverage. It used to be the case that in the past, underwriters had some sort of flexibility or discretion when it came to choosing whether or not they would accept a certain account, and if so, at what terms and premium. That discretion or judgment has more or less been entirely removed by the actuaries now, who are the mathematical scientists behind all of this. So there's a much tighter guidelines and restrictions that those underwriters have. They're less able to take a chance on something, which is at the end of the day effectively what insurance companies are there to do, is to accept risk. But we're just finding that the appetite for that risk now is much less than it had been a few years ago. With regards to reduced capacity, what that essentially means is that all insurers have to have the ability to write out checks for the promises that they're making. You can't have one insurer covering every type of commercial business in Canada, because if something disastrous were to happen, they wouldn't have the ability to make good on those promises. So insurers can increase their capacity through investment or through reinsurance rates where insurers buy insurance. Those rates are increasing as we see more catastrophic events globally, not just in Canada. One other thing that the insurers can do is exit the market or a particular class entirely. And we've seen that this year with a company called Allianz, a large European German insurance company, has been struggling to actually make money. Their combined operating ratio was running at 127%. And despite their efforts, they couldn't improve it. So they just decided to entirely stop writing business in Canada. And the same thing has happened with several Lloyd's syndicates who are underwriting as well, just not offering either on property or liability or both. And of course, whenever there's a reduction in the market, there becomes a smaller amount of competition, and therefore premiums tend to go up.
So the opposite of the hard market is obviously the soft market. We've been kind of moving out of a soft market into this hard market for approximately 3 years now. And it's been kind of a little bit of a gradual ride into the hard market. In terms of what we're expecting, I guess it depends on who you ask, but we can anticipate it probably lasting, a minimum of another 6 months, probably to a maximum of 3 years, with likelihood of it being somewhere in the kind of 2-year range before we start to see a softening of the markets and the opening up of the things like market gone over, lowering of premiums, increased coverages, and easier response from underwriters and ability for them to place coverages in different areas.
I think it's important to mention that we're not here to defend insurers' actions. I mean, obviously they're not a public service; they are there to make money, but they do have a slightly difficult job in that they have to predict the premiums based on the information from yesterday to set the prices for today for the losses of tomorrow. So although there is actuarial science involved, there can be several factors that influence that, and there's almost a perfect storm of these issues coming together at the moment, which is what's causing the sudden shift in availability and pricing. So sorry. So we move now to from what we can't control, which of course is the global insurance market, to things that we can control. And this is probably the most important part, because it's something where we can have an influence on the outcome. The first point on here, in my opinion, should be highlighted and have flashing lights around it, and is probably the most important takeaway from today's webinar. And that is to start the process early. I know Matt and I were talking earlier, and we've lost count over the last 6 months of the number of times that we've had a call on a Friday morning from a new client or someone who's having difficulties, and their renewal is due on the Monday or very early the following week. And with the best will in the world, even if we had a submission out to all insurers within 5 minutes, there's a very low likelihood of us actually being able to achieve any kind of significant result. The other difficulty with a hard market, of course, is that nobody wants to see increases, so they all tend to shop everything. So every single policy is shopped. There's only a limited number of underwriters available. And you can imagine, I think one underwriter mentioned to me the other week, they'd received 300 odd submissions in one morning. They just simply can't physically process that many quotations in that time. So we tend to start the process early, around 90 to 100 days out. That way it gives us the opportunity to approach a much larger number of insurers and to chase them up to ensure that we get some kind of response. And then basically at the end of that, we can review the results and provide recommendations on that basis. But the key thing is if you're looking at a commercial renewal now, if it's due in around February time, now is the time to start the process. If your renewal is not due until August, then just make a diary note for early May next year to start the process at that time and be proactive in that regard.
And one of the other important parts of going out early to the markets is that the quality of the information that you're providing to your broker or agent is very important. One of the things that we kind of find is some clients kind of push back towards the information that we're trying to collect from them. It's not that we're doing it to kind of be a pain or to cause any problems. It's kind of the opposite. We're trying to collect as much information as possible to paint the best picture possible for the underwriters and to be able to present your business in the best light. This is important, as Mark said, with this hard market and the amount of submissions that underwriters are seeing. They're looking for the cream of the crop. They're looking for the ones that have the most amount of information, the most amount of updates, the ones that they really don't have to do as much research kind of on. And that's our job as brokers, is to collect all that information and give it to them so that they can provide the best terms and conditions as possible.
Yeah, I think a large part of that is particularly with regards to property is knowing those four main areas: the roof, the electrical wiring, the plumbing, and the heating. Generally speaking, most insurers are accepting of updates provided they're within 20 years. The exception being a steel roof, for example. But red flags for most of the standard insurers will be things like aluminum wiring, fuses in place of circuit breakers, galvanized plumbing, and oil heating. They all have increased exposures for those insurers. So sometimes it can be worth spending some money on getting those upgraded or replaced, and it might widen the market available to you. There are specialist markets that are still able to provide coverage for those property risks, for example, that have a 60 amp service and fuses and aluminum or even knob and tube wiring. But they're going to be few and far between, and therefore the premiums are going to be higher as a result, and the coverage is going to be more restricted. One of the things we're tending to see more and more these days is the transfer of risk through contractual terms. And this can actually be to your advantage. If you're requesting a certificate of insurance from any of the contractors that you're using, naming you as additional insured, you're essentially getting evidence that their cover is being extended to include you and protect you, and therefore minimize your exposure. So if you're doing that process, then we would like to sing it from the rooftops for the underwriters, because it demonstrates a proactive risk management stance. This is particularly important with the winter season coming up. Snow removal is certainly a large exposure for all insurers. If someone takes a slip and fall on your property, as a property owner or even as an occupier, you can be named in a suit. But if you're having a professional third-party contractor do that, then obtaining this certificate of insurance is invaluable.
And like Mark said, one of the, if you are in the snow removal industry, you'll know that this is one of the industries that is really being hit the hardest on the insurance side of things at the moment, with a lot of the capacity being taken away and the premiums increasing very significantly. One of the things, like Mark said, is getting that certificate of insurance from whoever's doing your snow removal is important, because at this point in time, it's important to know that they actually do have insurance, as there are a number that unfortunately are deciding to go without because the costs are so high at this moment. Sorry.
I was going to say, being proactive with regards to your risk management, if you have, for example, a maintenance plan in place or a training schedule, these are all positive things that should be shared with your broker. If your fire extinguishing appliances are tagged each year, then again, I always take a photograph if I'm out physically at the location to demonstrate that. Things like certificates for fire suppression systems, sprinkler systems, any of that kind of thing, schematics of or diagrams of all of those risk reduction measures, that they're all positive things that can be used to help fight your corner, essentially, with the insurance company.
And finally, on the last point there, is that your broker should be a trusted partner. We're always trying to build the relationships with our clients. And it kind of goes back to what I said a couple of minutes ago, is that, we're not asking the questions and not, asking you to fill out extra applications because we're trying to be difficult. It's trying, like I said, to paint the best picture as possible for you and the risk that your business presents. And we should always be trying to work together as partners.
And one of the big things there that I notice is that quite often some brokers will just deliver a renewal and say, well, that's the best we could do. There's a 20-25% increase. There's nothing preventing you from asking that broker, well, what other markets did you approach? How was it presented? How early did you go out to the market? All of those questions, I mean, they're there to represent you in the insurance market, and therefore should be going through that process for you. So you can ask questions and have a discussion. And yeah, it's important that you're ensuring that your account is being presented in the best possible light. I always prefer, if I'm taking photographs of locations, I prefer to go out on a nice sunny day when there's not snow all piled up around the building, rather than on a grey overcast day, or if there's pallets stacked up against it. You're not doing the insured any favours by taking a picture of that and sending it off to an underwriter. They want to see a positive physical risk, essentially. So one of the big surprises to me when I did arrive in Canada several years ago was that the perception seemed to be that if you'd had a claim in the last 5 years, and 5 years seemed to be the magic number, that was it. You had to stay with the same insurer for that time, regardless. The first few accounts that I had inquiries from for new clients, one had an open liability claim. A couple had other previous claims in the last 2 or 3 years. The important thing from our point of view is that underwriters are looking not so much for what's happened, they're looking for patterns, but more importantly, they're looking for what has been done to prevent something from happening again. So in the case of a liability where there was a handrail missing, for example, then if you physically go out and take a picture of that, or the lighting around the stairs, that demonstrates that risk has been at least reduced, if not removed entirely. If there's additional training that's been provided, or there's been a change in the type of operations or the way you do something, I mean, we're all human, we all make mistakes. It's whether or not we learn from them. So if insurers are seeing a pattern of slip and falls because snow's not been removed year on year on year, you're not going to get anywhere. But if it's a one-off in 20 years and there is a story behind it, that's the important aspect, is telling that story, and again, getting your voice heard through the underwriter to make that exception. There's also other things that you can do. I mentioned earlier risk transfer through contract terms. things like waiver of liabilities and hold harmless agreements are becoming more and more common. If they're in your favor, then again, that's another positive thing that we can shove under the nose of the underwriter to present your case.
All right, so that kind of brings us to the end of the basic information that we wanted to cover with everyone. Does anybody have any questions? I haven't seen any come through the Q&A.
No, I haven't seen any either. I just might ask a couple. You had mentioned, if you don't mind, just as I try to catch up. So you mentioned there are particular industries or particular people who are more at risk. Do you want to just kind of remind me who that is? Like who should, if I were going to send an email to my members that are most at risk with premiums rising or being impacted by this hard market, who would you say I need to reach out to?
Well, there's been a lot of coverage in the media recently relating to hospitality industry, particularly restaurants, bars, etc. I think it's no secret that those business owners are facing a double whammy at the moment, in that obviously receipts and revenues are down, yet they seem to be targeted by the insurance industry for higher premiums. Now, a big part of that is to do with the host liquor liability exposure and the increase in litigation, both the amount of litigation, also the amount or the quantum of settlements, and the reduction in the number of insurers that are actually offering cover for hospitality risks. It is seen as a non-profitable area for insurers. So that will be one. The important thing there is to make sure you're dealing with a broker that has access to more than just one or two markets. There are still insurers that are offering coverage for hospitality risk, subject to certain guidelines. I think Echelon this week announced that they're re-entering the marketplace. I think there's been some provincial government pressure on insurers to find a solution for this. Again, I mean, if any other business, if you're a furniture retailer, for example, it doesn't matter how hard you're lent on by the provincial government. If you're selling, sectional sofas for $800 that cost you $1,000 to produce, it's not a good business model. So I think there has to be some kind of meeting in the middle. Quite often, the other aspect is that you can actually separate out your property from your liability coverage. I've had to do this a couple of times over the last few months. There are some insurers that are happy to provide the liability for the CVL and the host liquor, but they can't do property, and vice versa. Now, in an ideal world, you should have both with the same insurer, but these are not ideal conditions. So that is an option as well.
And with the hospitality, the higher your liquor receipts are, the more difficult, and the less amount of markets there are out there that are looking to place that coverage. So the places that are more bar and less restaurant are really feeling the pinch from the insurance industry. That's for sure. The other one would be snow removal. Snow removal is a big one. Anyone who's especially smaller snow removal companies are really struggling to find coverage, and when they do find it tends to be fairly expensive.
There's one more that we would add to that list now, and that's residential realty, whether it's a single family dwelling house or condo buildings, anything in between, whether it's a sixplex, duplex, etc. There's fewer and fewer insurers now that are willing to offer terms on residential realty. Part of that is due to the aging infrastructure. Escape of water claims are now exceeding flood claims. So a burst pipe is costing them more than flood, and flood is costing them enough as it is. But also things like fire exposure. If it's older wiring, that can be an issue, and that's why underwriters are targeting that. So there's fewer insurers in the marketplace that are offering cover for residential realty. And again, it comes down to how you're presenting it. Are you looking at different deductible options maybe? Are you reviewing the limits that you carry? Are they adequate? Are they overinsured? All of those things can go into to help improving the position.
There was another question here. We actually did have a question now. So Isabel has asked about error and omissions insurance and or other professional engineering services. Do you deal with those, and do you have any recommendations there?
We do. In fact, errors and omissions came up in the news yesterday as having one of the highest increases in rates. Errors and omissions, also known as professional liability, it is a specialized line of coverage. We're fortunate in that we deal with around a dozen or so insurance companies that can provide that cover. It's something which engineers, architects, accountants, insurance brokers all need to provide coverage and affect the advice giving. There has been a sudden increase in those rates and a reduction in the availability of cover. The main reason being is that the insurers are anticipating a much larger number of claims, partly due to the current situation. When there's an economic downturn, people naturally turn to litigation to try and improve their position. Some may even use it as a bargaining tool with regards to contractual obligations. So, of course, if they're anticipating an increase in claims and resulting litigation, then the premiums increase also. The good news is if you're dealing with a broker that has access to a large number of insurers, then you should ensure that there's no stone being unturned there. I think within the Canadian marketplace, if you add up all of the Lloyd's syndicates, the managing general agents and the direct insurers, there's probably around about 40 or 50 different ways to market that you can go through. And again, it's about presenting the information. If there's a claims history, what has been done to prevent a reoccurrence going forward.
And to kind of build on what Mark was saying there, we actually had a monthly meeting yesterday with Navicore broker partners across Canada, and our end of year was the end of October, and across the broker partners, we used over 90 different companies throughout the year to place insurance. So there's lots of options out there. You just have to partner with the right people who are able to access all of those different markets.
Perfect. Well, thank you.
Jill, I'd like to ask a question, if I may. It sounds like what sector the businesses are going to be in, so on the kind of increases they're looking at. But just to give people a general idea, because I have spoken with a few businesses, and one of them told me their insurance went up 300%. I'm not sure if that, and they said actually they couldn't even get it. They ended up having to go to an American company to even get insurance. So this is kind of scary stuff. What would you say would be a range of percentage increases that businesses should be budgeting for and expecting when they come up for renewal? When everyone's got different renewal dates, but obviously over the next 12 months, everyone's going to be renewing their insurance at some point. What kind of increases should they be expecting?
That's a very good question. Firstly, with regards to the first statement concerning that particular individual, it'd be interesting to know if there was a claims history or what kind of operations they were in. There are certain trade segments where there are literally only a couple of insurers available, so that may in fact ring true. But otherwise, again, it comes back to asking your brokers to, which markets did you approach, who are you dealing with, who do you have access to? With regards to the second question, I would hazard a guess, and it's very difficult to foretell what's going to happen in the market going forward. But I would suggest a minimum for budgetary purposes of 10 to 15% as an average. We do have the odd exception where there's an increase of only 3 or 4% to allow for the inflation. But otherwise, 10 to 15 tends to be the average. If you're involved in hospitality, as I mentioned earlier, then you're probably looking more at sort of 20% and above as a minimum. Some insurers are exiting the market, and if you're with that insurer because they had the best rates, then of course it's going to go up to the next best quotation. It really can be. I think there was a story in the news a couple of weeks ago about many Toronto restaurants facing 700% increases. in their premium, which, although newsworthy, I find I would certainly never be happy to present any kind of increase like that to a client of ours. Again, it comes back to starting the process early, and the way it's presented. You know, if you're sending a submission out to insurers and you're saying I'm not getting quotes from anywhere else to that insurer, that it's almost giving them carte blanche to pick a number out of the air, because they know that you're probably going to have no alternative but to go with it. So it's the way it's presented, the way it's submitted. But we've not had any incidents where it's been in the hundreds of percent for sure. I think in 20 odd years, I had one account where I faced non-renewal. In the last 6 months, there's probably been a dozen. So, and quite often it's nothing that the individual organization or operation is doing. It's just that insurance company or that market is exiting that class of business, because as a whole, it's not performing well for them. And I think that's a big point to make, is that the losses in this area don't necessarily reflect the GTA, but we're all in the same pot effectively when it comes to claims.
Yeah, when Mark and I were talking a little earlier about this, is like a common misconception with insurance is that, you know, you as an individual or as an entity, you pay X amount into a pot every year, and that's your individual thing. And you say, well, you know, I haven't made a claim in 10 years. Why is my insurance going up? Well, you have to understand that, you know, your piece is going into a much larger pot. And that pot actually is the global insurance industry, right? So a lot of these companies are global companies, and you know, if they're on risks in South America or Asia or Europe, and there's catastrophic losses there, like with the fires that were in California this year, and all of those affect your insurance. You know, you're always going to be rated based on your risk, but I mean, the global industry has to be able to catch up and make up for all of these growing losses.
Yeah, I think we only have to look at the weather we had last weekend. I think that's been forecast as being close to $25 million in losses just in Ontario. That was just one windy 24 hours. You had things like, you know, the disaster in Fort McMurray in 2017. The most recent Calgary hailstorm was the second worst natural event in Canadian history. It's projected to reach $1.5 billion as a single event. If you look at the last history of natural weather-related events, the last 9 years are the worst in history, and that's a big driving factor. There are other aspects to it as well, such as litigation. People are more aware of their rights these days. You know, 20 years ago, if I'd have slipped over someone's parking lot, I'd have stood up, brushed myself down, and hope no one saw me do it and go on my way. These days, if I slip over, I'm looking for who owns the building, who occupies the unit, who does the snow removal, how many people am I suing, and obviously there's a cost to the defense. You may have done nothing wrong. You've got snow removal logs in place, but it's going to cost $3,000, $4,000, $5,000 to extricate yourself from that legal action.
One of the things you guys talked about earlier was getting yourself named on certificates of insurance. And I know sometimes as an event, you know, with the chamber here, we get asked to do that for some of the venues that we hold events in. But it's not something that most people know how to do on a regular basis. Do you want to just maybe quickly go through like what that entails? Because it sounds like it would be a good practice for some businesses to get into, is requesting those certificates of insurance. And should they expect to be charged a cost for that?
No, there's no cost to doing that, and all that needs to happen is you need to submit a written request, usually by email, asking to be, well, you probably see it yourself when you have these venues. The reason behind it is if you go into a venue, a hotel, for example, and you've caused damage through negligence, I don't know, you've left a projector lead somewhere and somebody's tripped over and been injured, that venue doesn't want to be held responsible for your negligence. So by extending your cover to include them, the exposure is handled under that particular insurer, and therefore doesn't reflect on their claims history and their losses. Because there's no cost to doing it, it's actually a very cost-effective way of transferring a risk to somebody else and effectively removing the potential for you to get involved in, or certainly minimizing the potential for you to be involved in litigation where you're not the responsible party. A good example I always use is we had our house re-roofed recently, and we insisted on getting a certificate of insurance from the roofing contractor. They're only going to be here for a couple of days. But if they dropped a bag of shingles on somebody's head or somebody's car, I don't want to be named as the property owner for that injury or damage. It needs to go against the insurance of the roofing contractor.
So it sounds from what you're saying that this is maybe something that businesses should really think about a little bit more to try, because I think one of the points you said was to minimize the risk that they are exposing themselves to, because that will help when they need to get their premiums renewed. So, you know, it sounds like a lot of people should be maybe looking at their activities throughout the year and see where those certificates of insurance could be requested to lessen their own risk.
I agree. The other thing is it's becoming ever so more popular now, or there's an increased requirement by insurance companies to insist that you do that. So if you're a general contractor, for example, that employs subcontractors, it's quite likely now that your insurance company has a subjectivity or an endorsement or a request in your policy wording that says that you must obtain those certificates of insurance from your subcontractors. Because why, as a general contractor, should you be responsible or on the hook for the negligence or exposure caused by, you know, the electrical contractor, the HVAC contractor, whoever it is that you're using, when that claim should be against the subcontractor's insurer? So I think insurers are becoming more. It comes down to that restricted coverage or more aggressive underwriting. That's one of the ways that they can control the exposure for their insureds, is by transferring it to another party. So it may be just the fact that you have no option but to request it, rather than you know, the positive benefit of requesting it as well.
And the information that's needed is very minimal. It's just, you just need to know the name of the company and the address, and just say, you know, please add this company. It's really as simple as that.
Yeah, the insurer may want to know why, you know, if it's in respect of a specific event, or if there's a contractual requirement that they might want a copy of the contract. But for the most part, it's a fairly standard and quick procedure. It doesn't take long.
Well, that's great. I don't have any more questions, Suzanne. Thank you. I'm not seeing anything else in the Q&A. I'm glad we're recording this, because I know we had a number of people that had registered, and it doesn't look like they're all here. So we might have more questions coming out of it later. I know that you were working directly with Suzanne, but maybe you'll provide me your email address or contact information if anybody else has any questions. Is that fair?
Of course. Yeah, I'm going to send to Suzanne. We'll share the PowerPoint as well, and we'll just include our contact information on that.
No, thank you very much. I know it's a complex issue, and when we sent it out to our membership, we kind of said it is what it is, but this is a year where maybe you want to pay a little bit more attention, because it might be more than you expect.
Yes, yeah, for sure.
Thank you.
Thank you.
Okay, well, thank you very much for joining us and bringing your expertise to the businesses in Quinte, because I know that we're, Jill and I and our chambers, we're trying to provide as much information as we can to help our business members navigate through this pretty challenging time. And I think, you know, you might just be getting through the whole COVID challenges and making sure your business is ready to go that way. And all of a sudden your renewal comes up and it's not something you were expecting. So we really do appreciate you taking the time today to bring us all up to date.
Thank you for hosting us.
Thank you.
Yeah, thank you. Have a good day.